For decades, one simple fact has quietly shaped almost every price you encounter in daily life, from the fuel in your car to the food in your supermarket and the rate on your mortgage. Most global trade, most international debt, and most central bank reserves are priced in US dollars. Today, however, a group of countries known as the BRICS, Brazil, Russia, India, China, and South Africa, now joined by new members, is openly asking a once untouchable question: why should the dollar dominate the system forever? Some of these countries are signing energy deals in other currencies, others are building alternative payment systems, and their leaders speak more often about a multipolar financial order. The real question is whether this is political theater or the early stage of a genuine shift in how the world's money works. This report explores the forces behind the BRICS challenge to the dollar, how realistic a new financial order may be, and what these changes could mean for your savings, your debt, and your economic future. The BRICS are not just an acronym. They represent a large share of the global population, a growing share of worldwide GDP, and a significant portion of the world's energy, food, and raw materials. In recent years, several notable developments have occurred. Some BRICS countries have signed bilateral agreements that allow trade settlement in local currencies rather than dollars. China has expanded its cross-border interbank payment system as a partial alternative to the dollar-centric SWIFT network. And discussions continue, sometimes symbolic, sometimes more concrete, about BRICS financial architectures, from development banks to potential joint currency ideas. Meanwhile, the U.S. and its allies have used the dollar system as a tool of foreign policy, employing sanctions, freezing foreign exchange reserves, and pressuring financial institutions to follow Western rules. For many emerging economies, this raises a deeper concern. If most reserves and payments depend on the dollar, how vulnerable are they to decisions made abroad? This is the context in which BRICS leaders speak of de-dollarization and a new financial order. To gauge how serious that challenge is, we must look at how the dollar came to hold this role in the first place. The dollar's rise as the world's dominant currency truly began after World War II. In 1944, the Bretton Woods Conference created a monetary system in which currencies were pegged to the US dollar and the dollar itself was convertible into gold at a fixed rate. This structure made sense. The United States had a powerful post-war economy, held most of the world's official gold reserves, and had a stable financial system. The system worked for a time, but by the late 1960s, growing imbalances made it unsustainable. In 1971, the U.S. ended the dollar's direct convertibility into gold. Many expected the dollar's influence to fade, but instead it evolved. During the 1970s, the petrodollar system emerged, ensuring that oil, the world's most strategic commodity, continued to be priced and traded largely in dollars. Countries that needed dollars, and oil exporters accumulated dollars and reinvested them in U.S. assets. Over time, scale and trust reinforced the dollar's role. The U.S. Treasury market became the largest pool of safe assets. Global banks used the dollar for loans and deposits. International trade contracts defaulted to the dollar even between countries outside the United States. By the early 21st century, the dollar had become not just a national currency, but the core infrastructure of global finance. It is this structure that BRICS discussions now challenge. Understanding whether a new financial order is realistic requires examining the incentives of the major players. The BRICS countries are far from uniform. China wants to increase the yuan's role in global trade and finance and seeks greater autonomy from the dollar system. Russia, facing heavy sanctions, wants to reduce its vulnerability to Western financial pressure. India values flexibility, using local currencies when possible, while still relying on dollars when convenient. Brazil and South Africa are interested in more accessible financing and greater influence in global institutions. For all of them, the dollar is both useful and risky. It simplifies trade, but concentrates financial power in a single center. The United States, by contrast, benefits significantly from dollar dominance. It can issue debt in its own currency at low interest rates and enjoys what economists call an exorbitant privilege: the ability to borrow cheaply because the world views its assets as safe. The U.S. also wields access to the dollar system as foreign policy leverage. Yet there are trade-offs, including pressure on U.S. exporters and wider global imbalances. Losing dollar dominance would weaken a major pillar of U.S. influence. For other countries, companies, and families, using the dollar often reduces transaction costs and exchange rate risks, but it also exposes them to vulnerabilities when the dollar strengthens and global conditions tighten. And even if a household never holds a single dollar, the currency still shapes imported inflation, interest rates, and financial stability. Currency dominance may seem abstract, but its effects reach deeply into everyday life. When the dollar is strong and central, countries that import energy and food in dollars face higher costs when their own currencies weaken. That can push domestic inflation higher. If more trade shifts into other currencies, some countries could reduce exposure to dollar swings, though they might take on new risks tied to currencies that are less stable or liquid. In times of global financial stress, investors often rush into dollars and U.S. assets. This strengthens the dollar, raises the cost of servicing dollar-denominated debt elsewhere, and puts pressure on governments, companies, and banks. If a country carries large external debts in dollars, everything from public services to taxes to job markets can be affected by decisions in Washington or by movements in global bond markets. A financial world in which BRICS countries borrow more in their own currencies could reduce some vulnerabilities, but would take years to develop the depth and trust that the dollar system has built over decades. Families also feel the effects through savings. Pension funds, insurers, and sovereign funds often hold significant dollar assets. A gradual diversification of the global system could expand long-term savings options, but would also introduce more complexity. Understanding currency risk may become even more important for households worldwide. Looking ahead, the dollar is not likely to be replaced overnight, but the structure of the global financial system can still shift, even if the dollar remains central. One possible path is a world where the dollar stays dominant while alternatives grow. More trade between BRICS nations might be settled in local currencies. Regional financial arrangements could expand, and some countries may diversify their reserves modestly into other currencies or gold. The dollar would remain the anchor, but the system around it would become more plural. For households, the dollar would still heavily influence global prices and financial conditions, though shocks might be absorbed differently. Another possible trajectory is a more fragmented financial order. This could involve a dollar-centric system among the U.S. and allies, a partially UN-influenced sphere around China, and some BRICS partners, and other regional arrangements in regions like the Middle East or Africa. Some trade routes and financial flows might bypass the dollar entirely. Sanctions would become less effective but more complex, and global coordination in crises would grow more difficult. For everyday people, this environment could bring more volatile exchange rates, differing inflation paths across regions, and greater need to monitor which currencies their countries and institutions rely on. A third path is the gradual erosion of dollar privilege. The dollar would stay central, but the benefits it provides to the U.S. would diminish. Other countries would build deeper markets in their own currencies, reducing automatic demand for U.S. treasuries and putting upward pressure on U.S. borrowing costs. This would not resemble a sudden collapse, but rather a slow rebalancing. For families in the United States, this could translate into gradually higher interest rates and more fiscal pressure as debt servicing becomes costlier. For families elsewhere, the world might feel slightly more balanced, yet without a single new financial hegemon. A final, more dramatic path is a crisis-driven reset. In this scenario, a geopolitical conflict, sanctions shock, or financial crisis triggers a rapid move away from the dollar by a group of countries. BRICS members and others would accelerate their use of alternative systems out of necessity. Changes that normally unfold over decades could be compressed into a far shorter period. This would carry substantial risks, including volatile exchange rates, pressures on banking systems and sovereign debt, and potential losses for households if inflation or instability rise sharply. Although this scenario attracts headlines, the most likely reality remains gradual evolution, not sudden replacement. When people hear debates about BRICS versus the dollar, or talk of a new financial order, reactions often swing to extremes, from believing that nothing will ever change to predicting the dollar's immediate collapse. The truth lies somewhere in the middle. The BRICS challenge is not simply about replacing a currency, but about countries seeking greater influence in a system they believe is unequal, reducing vulnerability to sanctions and external shocks, and building institutions that reflect their growing economic weight. For the dollar, the question is less about survival than about the degree of dominance. For families, the essential lesson is not to be distracted by dramatic headlines, but to understand how global systems quietly shape local realities. Whether the future resembles a world with a dominant dollar and expanding alternatives or a gradual erosion of dollar privilege, the direction is clear. The world is moving from a system defined by one overwhelming financial center to a more complex landscape with multiple poles of influence. In such an environment, financial literacy becomes even more important. Understanding how inflation, interest rates, and currency risk interact, recognizing how global events filter into personal budgets, and seeing that no system is static and that change can bring both risks and opportunities. Thank you for watching the Atlas Economy Report. If you found this analysis useful, consider subscribing and turning on notifications so you don't miss the next video. Your support helps us continue creating educational content on global forces, personal finance, and the economics shaping everyday life. We appreciate your time, and we'll see you in the next report.